I've been getting this question a lot lately. Brad, is it time to fix my mortgage? And it's a good question because there's no secret that interest rates are increasing. However, unfortunately, the answer isn't so straightforward because you have to consider, is the current fixed rate justified given the anticipated rate rises that are coming? Now, I did touch on this topic in a previous video, which you may have seen, but I just want to go over it again today, dig a little bit deeper, and I've made a spreadsheet which I think you guys are going to like. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. And today we're talking about fixed versus variable rates and helping you to determine which one is more appropriate for you. Now, before we jump into the numbers and get the spreadsheet cranked up, you need to understand a little bit about how fixed rates and variable rates are determined. Fixed rates are actually determined by the bond market because banks use market rates in order to borrow money to on-lend to customers, locking in a rate for that set period of time. And now, because investors have been anticipating a rise in interest rates, they've actually been selling out of bonds, which has caused the yield to increase. There's an inverse relationship between the price of the bond and the yield. You can see from these graphs that the yield on a 1 year, 2 year, 3 year, and 5 year government bond have all increased substantially over the last 12 months. Variable rates, on the other hand, are largely influenced by the Reserve Bank of Australia's official cash rate. The cash rate is an overnight rate that flows onto the interest rate as banks can lend to or borrow money from the RBA at that rate. This means that if the cash rate increases, the cost for banks to borrow increases, and that is passed on to consumers through higher interest rates. So based on what we've just been through, I think it's a fair statement to say that variable rates are determined by what's happening now in the economy, and fixed rates are determined by expectations of what's to come. And in terms of helping you determine what's better at the moment, fixed or variable, I've put together a little spreadsheet to help us do the calculations. And now, I'm no Excel wizard or anything like that, but I am proud of this one and I think you guys are gonna like it. So this is what the spreadsheet looks like, and as the name suggests, it helps to determine if a variable or a fixed rate is going to be better for you based on expectations of future rate increases. Bear in mind that there are other factors to consider other than expected rate increases, and we're going to touch on a few of these other factors at the end of this video. So to start with, you need to fill in the input section. I'm going to put in today's date. I'm going to assume a loan balance of $500,000, and the variable rate is the current variable rate that you have on offer. For the purpose of this, I'm just going to assume the current variable rate is 2.45%. Next, you need to input your fixed rate details that you want to compare it to. So for the purpose of this, I'm going to assume my bank is offering a fixed rate of 3.94% for 2 years. You can see that the spreadsheet automatically adjusts the tables based on the fixed rate term. Now, if you don't actually know what your options are, then it's probably worthwhile having a chat to a mortgage broker. The last piece of information you need to put in is the monthly rate increase estimate. This refers to your estimate of how much the RBA is going to increase the official cash rate by. This is the most tricky piece of information to fill in because no one actually knows what's going to happen. Even if you ask Philip Lowe, the head of the RBA, what the interest rate is going to do, he wouldn't tell you, but he probably couldn't tell you either because it depends on what the economy does moving forward. So unfortunately, we're just going to have to make some estimates here. And forecasting really is the only tool we have available to us at this stage. I'm going to base my assumption on the predictions put out by Commonwealth Bank. They predicted a 0.25% rate hike in June, July, August, and another in November and another in February. This will bring the official cash rate up to 1.35%. So let's put that in the spreadsheet. Now let's look at the output. The effective variable rate over the 2 year period is 3.48% and the effective fixed rate is 3.94%. So based on these assumptions, no, you wouldn't fix your mortgage, you would keep it variable. Now this obviously can change quickly, and if you start inputting additional rate hikes, then you can see the numbers suggest fixing becomes a better option. Also bear in mind that this spreadsheet does assume that every single interest rate is passed on to the customer. It's no more or no less than what the RBA has done. And we've kept it as interest only repayments because obviously I want to keep it as like for like as possible. So if you start having different repayment amounts between the different loan types, fixed versus variable, then it's gonna skew the figures. Now, if you'd like a copy of this spreadsheet, then send me a DM on Instagram with your email address. I was gonna tell you to put your email in the comment section below, but I probably wouldn't do that. You never know who's gonna get hold of it and start sending you all kinds of random stuff. So jump on Instagram, send me a DM with your email address, and I will email through the spreadsheet. Now, there are other variables to consider other than the anticipated rate rises, and let's cover off a few of those high level now. Fixed rates typically limit how much additional repayments you can make. So if your goal is to pay down the mortgage quickly and you have the cash flow to do it, then fixing might not be the best idea. On the contrary, if your cash flow is very tight and you can't possibly incur rate rises that would put the effective variable interest rate above the fixed rate, then you might want to consider fixing from a certainty perspective. And finally, majority of lenders don't allow an offset account against a fixed loan. Now, if you've been following me for a while, then you're probably aware that I do like a good offset account. But that's it for me. Thanks a lot for watching. I do hope that you like this video, and if you want a copy of that spreadsheet, flick me a message and I'll send it through. I'll see you guys in the next one.